Over the last couple of weeks, there's been some quite important news come out from the macroeconomic level in terms of what's happening to investments and where we expect investments to head. In the United States, their economy grew at an annualised 4.2% in the June quarter, and that was quite a significant rebound after the economy had contracted in the March quarter, and profits in the United States grew quite strongly. We've also seen really good results coming out from US corporates as reported for the June quarter, and that's again helped lift share price in the United States. While those share prices have actually gone up significantly over the last 12 months, what we're finding is that the forward-looking price to earnings ratios, in other words a measure of how much you pay for a dollar of earnings, is actually remaining at quite average levels when you look back over the last 20 to 30 years. So we'd be saying the US market, it's starting to look a bit toppy, but if this earnings growth continues, which we expect it will through 2014, 2015, and into 2016, we believe those valuations are actually quite justified. In Australia, the economy grew at an annualised 2% in the June quarter, so we're starting to see that issue we've spoken about for a while, where the US economy is likely to be growing faster than the Australian economy. That relatively slow rate of growth has sort of been referred to by the Reserve Bank Governor in a speech he gave here in Adelaide yesterday, where I think he's sort of saying monetary policy is actually going to remain accommodative. In other words, the cash rate of 2.5% is going to remain there a bit longer, I think, than people expected. In fact, I think the Reserve Bank expected. We see that having an impact on the share markets because as term deposit rates continue to fall because of the continued low cash rate and the very high deposit raisings and good capital positions of the banks, they don't need the funds like they did back in 2009, 2010. We believe people searching for income are going to keep on going into the share market because of the equity income they can derive and the franking credits. We think that's quite important. So we think the Australian share market and the US share markets will continue to move higher, probably a bit slower, but there is some good value out there. You just got to be very selective in what you do.